Good afternoon and welcome to the new investment opportunities and strategies webinar series of the LPA. We started that new show recently and we started then with the PropTech sector. Today we are doing the same exercise again with infrastructure experts. Today's session will be then cut in two. First, with a quick introduction by Alexis, Head of Corporate Finance at KPMG Luxembourg. He will set the scene and give us a helicopter view on the infra asset class. Afterwards, we will then also move on to the panel, where different experts will then share with us different insights and certainly also their track record in the field. You can, as usual, then ask the different questions via the chat function or the Q&A button, which we will monitor during the show. A Q&A session will also happen at the end. The show will be recorded and we are very happy to have you here today with us. Okay, so then without further ado, let's move on then to the introduction and to Alexis, Head of Corporate Finance at KPMG Luxembourg. Hello, Alexis.
Hello, good afternoon. First of all, thanks for the invitation to participate in this webinar. So as Stefan said, I will do a brief introduction on the asset class and then discuss some of the trends we are seeing, especially on the impact of the COVID crisis in this asset class. So as main characteristics and why people look at infrastructure as a different asset class is you have many characteristics that make it very interesting for investors. The size, obviously, is something to consider. So you have massive tickets being invested here. They have natural monopolistic features, low market correlation, so which is a bit contradicting right now with what we're seeing with COVID. Highly leveraged, high sensitivity to interest rate movements because of the leverage, stable operating cash flows, long-term yields denominated returns, and non-recourse financing. The main characteristic, I would say, is the fact that you have a very long-term view on these assets and very predictable cash flows. When it comes to expected returns and risk, it really depends on the type of assets. You have the mature PPPs or public-private partnerships, like social infrastructure, like for instance. So on the other side of the spectrum, as high-risk investments, you have the demand-based assets such as airports, which obviously right now are being massively impacted. So the impact of COVID. So first, you have to see that, okay, right now, 2021, we are expecting a small recovery in the world economy after a massive contraction last year. European countries have responded through fiscal and monetary policies. And the ECB has launched a 1.8 trillion emergency purchase plan to help liquidity in the markets. When you see the impact on the economies in Europe, well, we have seen contractions in the main countries, but high expectancy of growth for 2021. The stocks have also been impacted, but now, since the 18th of March last year, we have seen a recovery of 60% after a massive dip for the first quarter of last year. When it comes to infrastructure, as I mentioned, they have been massively impacted. So if you see operators, for instance, airport operators have suffered 20%. But renewable energy has soared with 67% increase, mainly driven by investors moving towards sustainable assets. The yields also have now normalized, but we saw a lot of volatility last year in the same time period. Now, when it comes to the impact of COVID on the valuations, what we have seen is an increased number of valuations being requested by investors and regulators. The going concern status has been assessed more closely. Company-specific premiums and liquidity risk are now being considered and looked at with more detail than before. Consider scenarios adjusted based on market evidence in business plans. So business plans are now being looked at differently and scenario analyses are being performed. Sure. And now specifically on infrastructure. So obviously traffic volume, assets such as airports, toll roads have suffered, and the expectancy is that it will take still a couple of years for them to normalize. Reforecasting is happening. So when it comes to valuations, people are performing expected values based on different scenarios, based on, also on the recovery of the economy. Delaying CapEx is something that we are also seeing, and uncertainty recovery due to changing behavior. So obviously some asset classes will suffer more when it comes to the new normal. Impact of financing. Banks are not providing financing at the scale we were seeing 1 year ago. Investor sentiment, even though in infrastructure, people are still looking at infra as a safe asset class, yeah, investor sentiment has changed. And obviously public versus private. Privately held assets show an on average less severe value impact than listed assets, but directions are comparable. This is an analysis we have done on assets we have valued. Obviously, volume-based assets have suffered more than others, as I have mentioned. So in the range between 5 to 15%. Regulated utilities have also seen a massive dip of up to 10%, whereas PFI, which is UK specific, and renewables have been much more stable. On my side, that would be it. Thank you very much.
Thanks a lot, Alexis, for sharing your views. Now we will move on then to our panel, which will also heavily focus on the GP perspective. So today we have on board Nathalie Brabers, GP Director at EQT Partners. We have Ingrid Edmund, handling European infrastructure investments at Columbia Threadneedle Investments, and Aurelien Roelens, who is Investment Director and ESG Coordinator at Cube Infrastructure Managers. Welcome to all of you. What are for you the key characteristics of infrastructure investments? Please share with our audience your experiences, exposure, and also track records. And if you want to highlight that with concrete examples of features you would like then to really share with our audience today, please do it. So let's start. And don't forget to introduce yourself too.
So as Stefan mentioned, my name is Nathalie Brabers. I'm working at EQT for about 6 years, and I'm the portfolio manager and conducting officer in the infrastructure funds. So just to elaborate a bit on your questions, Stefan, on the key characteristic of infrastructure assets. So if we take a bit a step back and maybe spend a minute on why are infrastructure investments so important. I think we all realize that today the society and the community today is growing, and the society is relying on well-functioning infrastructure. And this is critical for the long-term economic growth. Just to name a few examples there that we can all relate to, we all see a need for example, well-functioning transportation, better digital connectivity. For example, another example is a need for good elderly home systems or better water management, just to name a few. So if we look a bit more at the business rationale and the key characteristic of infrastructure investments, these are covered by 4 pillars, which covers, first of all, utilities, which is more the electricity and water distribution, for example, energy, the renewable energy, etc. Transportation, you need to think of rail, roads, bridges, and social infrastructure, which becomes also more important today, like schools, hospitals, etc. All these investments have the same characteristics. They all have stable and predictable cash flows. And this is due to long-term contracts, but also lower risk profiles due to the nature of the assets. And typically in infrastructure investments, you also see a bit longer holding period due to the nature and the time you need to develop these assets. So that's the key characteristics. Usually investors also like to invest in these assets, also as it gives good diversification opportunity for investors to invest in different asset classes. One of your other questions, maybe Stefan, was a bit the experience and track record. At EQT, infrastructure has always been one of our core strategies since start. We launched our first infrastructure fund in 2008. And since then, we have really built our infrastructure investments in Europe. We have also expanded in North America, and we're continuing to develop in the APAC region. So quite a global investment strategy from our perspective. If we look a bit more at on the details of the investments, where we differentiate ourselves is that the value creation aspect is very important to us. We really look to invest in companies where we believe we can add value. So that's key in what we do. And we invest generally in investment in assets between 200 and 800 million investments, with typically control or co-control rights. Usually we invest in more in regulated environments, infrastructure assets, or concessions-based sectors, or service-related infrastructure. So that's what we focus on. If we want to name a few examples, for example, we have built a good track record over the last years, especially in the telecom fiber industry, where we have invested in a lot of different assets, also in a lot of different jurisdictions. It ranges, for example, our German investment in Exio, which is an investment where we connect millions of rural homes in Germany, so quite interesting from that perspective, but also ranging to the Nordics, where we also own some data communication and fiber companies, and to the US, where we have our key fiber company in the US, which connects thousands of buildings in the US and in Western Europe, and that we enable their video, mobile, social media, etc. So that's in a nutshell about our track record, Stefan.
Thanks a lot, Nathalie, for those very clear and detailed statements and explanations. That's very helpful.
Thank you.
Let's move on now to Ingrid. What about you, Ingrid? The key characteristics and experiences.
Yeah, so Ingrid, Edmund, I'm a portfolio manager in our European Sustainable Infrastructure Fund for Columbia Threadneedle. We set the fund up probably about 3 years ago, so it's a relatively new fund, which sort of we've had the opportunity, though, in our careers to over the past sort of 20 odd years to see what the key characteristics of infrastructure are. And what are those that sort of attract investors on one hand, and those that actually exist in practice and deliver on those expectations. So similar to what Nathalie was mentioning, when we look at infrastructure, we're really looking for those core characteristics. So they have to provide essential services. They have to be long-term. In particular, from our perspective, we are an open-ended fund. So that means that our investment horizon is sort of, you could say, forever. It's a perpetual fund, so we don't have a fixed investment period or divestment horizon. So we are there for the long term, which is commensurate with some of the life of these assets. So we're really looking at that alignment between the core characteristics and the duration of those assets. They have to have some kind of either to be regulated or to benefit from a monopoly or preferential position, you know, from a commercial perspective, to have contracts. So really, all of those things that together sort of bring that predictability and stability of the cash flows that is typically associated with infrastructure. The other elements to this, I mean, investors quite often are looking for an inflation linkage as well, especially long-term investors. Diversification, as Nathalie also mentioned, and from our point of view, diversification is probably going to be one of the key considerations, especially in a post-COVID world, because what this crisis has shown us is that just in being invested in one particular direction is probably not the way to ensure that low volatility and smoothness of returns over time. So looking to build a diversified portfolio of assets that have different exposures to different macro characteristics. So one of the things that we are also looking at is how do the revenues get actually generated? Is it contracts? Is it feed-in tariffs, for example, for renewable energy? Are they regulated? So we're looking to sort of mix all of those up at the portfolio level in order to ensure those characteristics of a core portfolio. And finally, again, from our perspective, sustainability, which we're probably going to go into a lot more detail later, but that is, apart from looking at it as a sort of an impact mechanism, it's also a risk management. So given that we're investing in these assets for, you know, the next 20, 30, 40 years, you really have to have, you know, sustainability as one of your key risk mitigants, because, you know, governments change, regimes change, all of these things, you know, you can never sort of guarantee that what you have now is going to be there in 5, 10 years. So one mitigant that kind of mitigates some of those risks is that your asset, you're managing the asset in a sustainable fashion, that your consumers or customers, stakeholders are happy with the service provided, and therefore it ensures some of this sort of long-term predictability of the asset. In terms of sectors, I guess, with, you know, it's Nathalie already mentioned, so we're also sort of looking across the utilities and energy space. Social, digital is clearly a new core sector of infrastructure. I think, again, if there were any doubts that some of the digital, you know, things like fiber and data centers, whether they work for infrastructure or not, I think COVID has showed us that they definitely have a place to ensure the good functioning of our society and economy, and of course transportation. And from our fund in particular, we are focusing very much on the mid-market. So we see a lot of opportunity in that space. We're looking sort of anything like 50 to 100 and 150 million equity investments. I think there's that space is still quite underpopulated. I think a lot of the infrastructure funds have been very successful over the past sort of 10 years or so, raised a lot of money, which means that the space in which they play, you know, means higher equity tickets. So there is that sort of mid-market space, which is offers a lot of opportunity and possibly not so much competition at times. And sort of in terms, again, recent experience, as I mentioned, we're a fairly new kid on the block. We've invested, for example, in a ferry company, which maybe doesn't seem such a good idea at the time of COVID when nobody travels, but on the other hand, the essentiality of the service, so providing sort of lifeline services between the Channel Islands and UK and France, for example, they've transported all the freight, so 90% of what gets consumed on the islands has to go through our ferries. And during COVID, when everyone was stuck at home, they couldn't travel, so we didn't have any passenger revenue. On the other hand, everything like food, medicine, parts of the hospital, medical equipment, all these kind of things had to go on the ferries, and that makes the asset very resilient in what is possibly the worst crisis ever. So that point of essential services is very much to the core of the infrastructure investment thesis. And at the other opposite side, we have invested in a data center, which again is a sort of newer infrastructure, seen sort of more recently as an infrastructure or core infrastructure space. And that we think is very sort of future oriented, and in particular combined with some of the green agenda that we're seeing developing. Investing in a green data center is possibly one of those quite interesting assets that we could have picked in this what is quite a tricky environment.
Thank you, Ingrid, for sharing your views and also putting some additional angles to the topic. And then let's now move to Aurelien, last but not least. What about Cube?
So I think for the definition of infrastructure, we've said what's are the most important characteristics. What's important to understand as well is with this definition around cash flow, the stability of the cash flow, the long term, the inflation link, etc. It also means that the infrastructure definition can change over time. We can extend the asset class. We can come back to that later in the panel. But typically, telecom 10 years ago was not necessarily considered infrastructure. It was considered a private equity play. And today it's the fourth. Sorry. And every player today in infrastructure is buying fiber assets typically. With respect to Cube, Cube was founded back in 2007. We're an independent Luxembourg-based manager. I'm saying independent because we're owned by 4 managing partners, which, and that might be a bit differentiating factor, are all coming from the industry as opposed to the finance world. So they are coming from, the big industrial groups like Vinci, Veolia Transport, etc. We've raised roughly 3 billion through 3 funds, 2 that are brownfield funds, 1 that is a greenfield fund dedicated to telecom, or rather fiber investments across Europe. And with all 2 funds, we are playing in the mid-market, which means that we target companies that are relatively small, with a co-control or controlling strategy and a buy and grow strategy. Just to illustrate the buy and grow strategy, for instance, with a telecom asset that we acquired back in 2011, Covage, we acquired this company. It's a French company operating fiber optic concession networks in France. It only had 14 networks. And throughout the years, through acquisitions, through gaining new concessions, new tenders, and also some private deployments, we end up with a bit more than 45 networks. They're serving, I think, roughly 2.4 million homes in France. And that's at that point last year that we sold the company. So also in terms of amount invested, the amount invested initially is much smaller than the amount that we've deployed over the life, I would say, our investment horizon. That's another characteristic that we have, and that we try to replicate across all sectors. We have 3 core sectors. Telecom, notably open access fiber networks, public transport, so it can be ferries, it can be buses and train, but always under concession contract where you are paid on the availability base, so we're not depending on the traffic. And our last sector is energy efficiency, whether that's district heating or all the renewables. And now we start exploring some of the sectors. We've made recently investments in EV charging or in the Internet of Things. That's, I think, a summary of our strategy and what we're trying to do.
Thank you, Aurelien, and for this first round of answers. What about the trendy geographies or types of investments you're closely following right now? What can you tell us there? Has something changed?
Again, it comes to expanding the definition of infrastructure itself. The same way that telecom was not considered as infrastructure a few years ago, and that was the same for social infrastructure. You have players like Antin that have invested in social, like diagnosis center back in 2015. It was not seen widely as core infra. It's not more and more adopted. And there are plenty of new sectors that start emerging, both with the digital transition and the energy transition. You can think of all the developments around hydrogen, for instance. So around hydrogen, of course, you have to switch from in public transport from the good old diesel bus to electric or hydrogen buses. That creates opportunity for infra players. But around hydrogen, you have the production, you have the storage, you have the transport of hydrogen. So we're trying, it's still new, but we're trying to take part in that. We are part, for instance, of call it a consortium that's called Ideal Ambition, which is 30 players, industrial players, and also a few funds, namely us, Meridiam, and Margaret, that are trying to figure out a way to create cheap or much cheaper clean hydrogen. That's one of the sectors that a lot of infra players are going to look at. You could list green ammonia, carbon storage, and in terms of digital transition, you have IoT, so all the Internet of Things, so whether it's 5G or low power, that can create new opportunities and new sectors to extend our asset class.
I guess just echoing to some extent what Aurelien is saying, of course, the sort of technology advances in transition sort of create a lot of opportunity. And in particular, I mean, we've set up our strategy to invest in Europe, and we see a huge amount of opportunity here as well in the transition story and decarbonization of existing infrastructure. So Europe has actually got huge incentives to support the transition to a greener economy and net zero and so on. So that creates a lot of sort of new opportunity in new sectors, new technologies, and so on, but also in some of the existing infrastructure, which is still pretty good quality comparing to, for example, the US or Asia, where it's sort of developing and so on, but that needs renewing, that needs sort of more resilience, that needs adaptation. And again, we see a lot of opportunity in this space. So this is kind of where a lot of our strategy is focused very much on identifying some of these opportunities where we can take that sort of active asset management approach, again, with control and so on, but really steer the companies towards a sort of more environmental, greener future. And again, for example, our ferry company, Condor Ferry, is one example. I mean, shipping, for example, is not even included in the taxonomy. But as a long-term investor, we're going to be there for the next 20, 30 years. Hydrogen is clearly one area that's very interesting for us, and we keep a very close eye, because that's where we really believe that the future of the fuel, for this kind of transportation is. And there's a huge opportunity to sort of invest now and work with those companies on their transition. And that also creates a bit of a premium sometimes in terms, other investors are perhaps looking for sort of the greener, the newer assets. It's just different strategies. So that just shows there's a whole spectrum of sort of old to new, greenfield, brownfield, sort of expansion, renewal, all these kind of things create a huge sort of universe and opportunities for many strategies. And I think from an investor perspective, it's important to understand what exactly it is that you're targeting, and then you can look around and see what's there, what's available to that fits your objectives.
Maybe just to complement there, I think as trans, we see, at least from our side, some greenfield projects kicking off. So that's more in the renewable energy sector, where we're going to build with solar and wind platforms. And interesting to see is that with these greenfield projects, we're also entering a new market. So we see now some greenfield projects in India, which is obviously a new jurisdiction for us. But also, interestingly enough, one of the broadest renewable energy market worldwide. So that's a bit what we see. Another aspect that we see is social infrastructure taking more and more space. I think this can also be explained with the current, you know, we'll get there, but probably the current pandemic and the situation where social infrastructure is becoming ever more important, as it really enhances the well-being of everyone and on the society. So that's a bit what we see from our side, and that's also links very well into what we do is that we have a thematic investment approach where these two trends link into.
Very interesting. And I heard also the word digitalization just before. So how quickly and strongly will technology transform the infrastructure sector?
I was saying it's definitely going to be quicker than we think. I think there's always this tendency to underestimate the speed of transformation. So I think we already seen, you know, we've seen over the last year, the speed of sort of change has been actually what we're expecting to happen in the next, you know, 5 years, you know, condensed in about 10 months. So I think again that's always been a sort of historical thing as well. Sort of people always think things are going to take longer than they really do in terms of change. We see lots of sort of new technologies coming into play. Even if you take sort of established spaces like sort of renewable energy, for example, where there's been a lot of investment in sort of solar and wind, you now see variations of that. You see more focus on the energy transition piece. You see, for example, we're looking at some projects which look at sort of solar thermal technologies, which again you don't produce electricity, you produce heat. And then sort of looking again at the digital space, you know, we have acquired this data center last year, and already, even if you look at just the last 2 quarters, there's been a huge increase in the client demand for space. So I think there's a lot more expected, you know, with all the trends of moving into you know, the working from home, everything is taking place online, everything is sort of virtual, and everything is adapting to that as well, including our activity as fund managers, fundraising, selling products to our customers from our portfolio companies. We see a huge trend of bringing all of that into the digital space, and that again creates a number of opportunities in sort of the adjacent sectors.
So we really believe that a digital technology transformation is key. So why do we believe that this is key? I think it's based probably on 3 grounds. You can look at it from an operational perspective. That's also obviously where I'm coming from, fund operations, but we believe that digitalization is really an enabler, and that you can build very efficient and scalable processes with digitalization and technology, as it gives also access to live and real-time data, which becomes key in what we do. On the other side, you have also from an investor's perspective, where digitalization can increase obviously transparency, security, and also provides for more available information towards investors, and that's obviously today what the investors want to see as well. So all this plus, I think we should not underestimate the more regulation there are, the more reporting obligations and requirements as well, which makes it necessary for private equity firms to accelerate basically the digitalization process. And the third part is that you also see technology playing a key role more at portfolio companies levels in different aspects. First of all, digitalization or technology can help portfolio companies to reach to add value at portfolio company level and to reach their full potential plan. So that's one side. And the other side, it also helps us to identify new trends and investments. And and stay ahead of the curve in terms of investments that we're looking at. And that's where we work with our artificial intelligence system, Motherbrain, where some of our ventures, for example, investments have been entirely sourced through this artificial intelligence system. So that's how we see technology playing a key role. If we look maybe at more concrete examples also, we have, for example, built over the last years a fully digitalized LP portal for our investors, which gives their direct access to funds documentation, for example, and also where they receive digitally all, for example, drawdown notices and distribution notices, and thereby limiting any exchange through emails. So that's one of our initiatives. More at portfolio company level, I would like to mention the example maybe on our container terminal business on the West Coast in the US, which has undergone over the last years a key digital transformation, and we really see today the added value of that. So it helps, for example, on that one, it helps, for example, to understand and in the help of unloading and offloading the containers from the ships, but also understand how the container and the volumes move through the supply chain, and also on the organization on the containers after they have arrived in the terminals, whether they will be organized by rail or by road. So we see important role, especially in that investment on the digitalization part. So from our perspective, we think that everything can always be improved. We definitely think that technology can improve a lot, especially in these times. And our mission and purpose today is to future-proof all our companies. We want to make them best in class and the best digital leaders as well.
There are many examples. This is a topic that is quite important for infrastructure players, the topic of digitalization. And it was even a question at some point for some sectors, would we see Uber or Airbnb for some type of assets like car parks, etc. But all infra players, I think, in their companies, they try to get ahead of the curve and use new technologies to be more efficient, whether it's making your managing and monitoring systems more efficient. That can be very small examples. I remember, for instance, for one of our companies operating trains in Germany, just the fact of having, I would not even call that AI, just a small algorithm helping the drivers, assisting the drivers, the train drivers, it lead to reducing the fuel consumption, so also the carbon footprint, but also economies directly in the P&L. We have some examples, for instance, also in monitoring wind farms where you can use drones. And overall, on top of that, it provides opportunity for us as investors to invest in what is supporting this transformation. The example I've given earlier in the Internet of Things, we've invested, for instance, in the infrastructure for the Sigfox system. So Sigfox system is enabling basically the low energy wide area network of objects. So simple objects, basic captors that would measure very simple things, send the information, but very useful to track anything that needs from the humidity on an agricultural land to a pallet that is traveling from one country to another. So there are plenty of opportunities that are brought by digitalization or more generally new technologies in the infrastructure sector. And it would be a wrong conception to think that the infra asset class is not moving in that direction as well.
Great. And that was then for the technological angle. What about external factors or shocks? Did, for example, the COVID-19 pandemic disrupt your activities? What about the impacts on, for example, the maintenance, on-site visits, valuations, fundraising, and also due diligence activities? And since I like really the mega-packed questions, any sectoral winners worth mentioning? Who wants to start?
Well, I can try to start with this one. I'll take from the sectoral winners, and it kind of is linked to Alexis' introduction. Is obviously all the assets that are very regulated, so what's called budget finance based, which are not tied to volume, are the winners in the sense that naturally they've resisted very well. So for instance, in our public transport sector, since the contracts are availability based, despite having less passengers due to COVID, it did not change the profitability of the assets. That's, I would say, for the very regulated or regulated asset based type assets. Now, obviously, when you have volume exposures, you have winners and losers. In the telecom, for fiber assets, all our companies were above budget, despite COVID and despite the difficulties COVID posed to them. And I think overall are well positioned over the long term, since everyone that was not convinced pre-COVID that having access to good connectivity was important, now is pretty much convinced with home working, etc. And obviously there are assets that have been affected. Alexis mentioned toll roads and airports. We don't have them in portfolio, but it's enough to see the results of the publicly traded companies to see that those sectors have been, at least today, affected by COVID. But to be honest, on the operation themselves of the asset, on fundraising, on even making deals, doing due diligence, it was a bit awkward at the beginning. There was a bit 2-3 months where we did not know what or how to adapt. But the impact is not that big. We did manage to do the maintenance because also, infrastructure being classified as essential, all workers were able to go on site, etc. So the maintenance of our assets was insured, and for ourselves, we did manage to make deals. We did manage to fundraise. It's a bit more difficult because, for instance, the absence of physical meetings when you're negotiating makes things a bit less efficient, I would say. But the difference is not huge either. I did not feel we were too affected in our operations by COVID, at least. I don't know if Ingrid or Nathalie want to comment.
Well, I think to some extent the impact sort of on a day-to-day, apart from working from home, has changed things. Like you say, things have been a little bit slower in some respects, in particular sort of things like fundraising, doing deals, things take longer. Operationally, at the level of the companies, of course, there has been all of this. I mean, ultimately, you have the management companies on the ground, the management on the ground sort of dealing with those companies. So, again, you just had to adapt to what COVID brought. And for example, if you're operating a transport business, you have a lot of health and safety to worry about, implement new measure, sort of think about what to do with your assets to manage, through this storm. For example, if you think about, our data center, which is on a fjord in Norway, so it's a very remote, safe, green, cold climate, everything you want, but not easily accessible. So the first few months after COVID have been a little bit slow. And then we had to implement, for example, a virtual tour of the operation. So, the data center itself is in a mine. So you had to sort of put, we've done this to enable them management implemented that so they can continue to sell the space. From our perspective, I think whilst you have a lot of companies that have done this, and you have drones, and you have very, they don't show you, for example, when you buy a new asset, they don't show you the stuff that doesn't work, right? So, or the dusty spiders in a corner. So it's not ideal to operate like this, and we're looking forward to the return of being able to go and see the assets in person. So yeah, in practice, I think it's been incredible how well the world has adapted to working from home, and being able to conduct all these virtual meetings and so on. Valuations wise, it's interesting because whilst of course you have a drop in revenues in many assets, and in particular transportation has been hit quite hard, so you could call them one of the losers to some extent in this whole crisis. And digital is a winner, but infrastructure investment is a long-term business. So ultimately, to the extent that you have the qualities that we were talking about in the beginning of this session, the essentiality of the services, they're there for the long term. They're there to service a real need of the whatever stakeholders, communities, and so on. 1 year drop in revenues doesn't necessarily mean an impact on the long-term valuation, because ultimately you're looking at cash flows that are meant to, it's 20, 30 years of cash flows. 1 year, to the extent that you bounce back to your normal activity levels, shouldn't have a huge impact on the valuations. Of course, you have the definitions of what's essential are changing, and there will be, it will be a little bit of adjustment once the world sort of again figures what is, where some of the assets are. I was asked, for example, recently whether we think that airports are stranded assets in the same way that coal-fired plants are. And honestly, I don't think that. I don't think that they're doing great on valuations right now, but ultimately they are needed, for the economic development and so on. So I don't, if you're an airport purely relying on transport, on tourism, not very sort of necessary location, you may suffer more than if you are a Heathrow or a Gatwick or, sort of major centers where actually the social benefits and the economic development benefits around that assets are huge, and you can't just replace them with there is no alternative to some of those things. So yeah, I think valuations on the medium term will bounce back if they've had a bit of a drop in the short term. I think Stefan should know better, because after all, his colleagues are doing a lot of the valuations on many assets. But it's a long-term asset class, and I think we need to remember that when we buy and when we manage these assets.
So in terms of impact, look, we see an acceleration of a few mega trends. I think we touched upon a bit earlier. There's definitely a growing momentum in the energy and telecom fiber business, given on how the society operates today, and the society obviously will need to keep up with the digital economy and the need and the ask for more data and connectivity. So that's one aspect when you need to think of. Students, kids being moving from more classical education to more homeschooling, corporates and companies moving also to more online working, which also means less need to communicate, less transportation. So it's just a new way of living in the society, and that's also what we see back in these mega trends. From a portfolio company perspective, we see the portfolio companies being quite resilient also through this COVID-19 pandemic. Of course, there are some that we are closely monitoring and some more impacted than others, but overall the portfolio is quite resilient, and that's also how we have prepared. We have prepared a few years back for the storm to come. We, of course, no one expected this COVID, but that's how we have prepared ourselves, and today seeing this quite resilient portfolio companies.
There is just one aspect that Ingrid mentioned that I think is important here is the health and safety, and that's not just in infrastructure. I mean, health and safety is a big topic for infrastructure. It got even bigger with COVID because it's not just the health and safety of your employees, it's of the general public, but also you had a bit of a spotlight on social issue and notably well-being at work, especially in those times, and I would even say mental health. And you can see that depending on where your assets are, there are different reactions from the employees, and you need to act also in that direction. As for instance, if I take the assets I'm overlooking, one is in Portugal, the other one is in London. In Portugal, it was overall fine. I would say the lockdown was less strict. It's nicer areas. Lockdown in London has been quite difficult. So we had to initiate some activities online, mental health program, mental health training, to make sure that the staff was still motivated, that all companies were still performing well through those times. So it's also refocused a bit on the S dimension of the ESG during the COVID times, which might have been a bit forgotten in the recent debates.
We certainly concur that resilience, reactivity, and agility are very important characteristics. And we have now really underlined the very positive aspects of the infrastructure asset class. But also, do you see any concrete challenges or obstacles which could prevent then the further growth of your sector? Anything on that front?
To be honest, I think infrastructure is still a very attractive asset class, and its performance even over the last year has made it even more attractive to investors who are, still looking for yield, still looking for all those characteristics. There's a huge amount of liquidity coming into the asset class, and if you look at the some of the investor surveys that are being done by Preqin, for example, or asset managers and so on, a lot of LPs, a lot of asset owners are saying that they want to increase their allocations to real assets. And the main beneficiary of that is one of the main beneficiaries is infrastructure, and whether it's on the equity side or on the debt side, you see huge appetite for that. So from that point of view, the money invested in the asset class by investors is growing, and I don't see in the short to medium term a change in that. From the point of view of needing that money, the private capital coming into infrastructure, again, there's a huge need. And you see a lot of the fiscal stimulus coming from the sort of governments and so on, incentivizing infrastructure and various sectors of infrastructure, but the private capital still has a huge role to play. So again, the investment universe is there. So I can't see anything that's at the moment going against this asset class. If anything, it's COVID has actually reinforced its place in in society and sort of portfolios in terms of asset allocation, what it can bring to an asset allocation.
There is still strong needs in Europe. If you say the usual markets, because most of the money in infra today is Europe and North America. If you take just Europe and North America, you still need to refurbish the existing assets. If you take the leakage rates, for instance, of water utility in North America, that's really not good. You will have to face and finance the digital transition and the energy transition, all the investment to become hopefully at some point carbon neutral. And then you have also, and they are not explored too much, all the investments in other markets. That could be South America, that could be Asia, that starts, and you see players, Nathalie mentioned that earlier, that are moving on this, but also all the African continent. And especially if you take Sub-Saharan Africa, that's still a place where you have massive greenfield investment opportunities. So the infrastructure asset class has quite a good room to grow further in the next 10, 20, 50 years.
I think just to add very briefly from my side, I mean, maybe it's not so related to this asset class. What we see on the market is that obviously the competition out there is high. There's a lot of assets with the high prices that go with it. On the other side, you also see the governments having less resources to invest in infrastructure assets and improve them. So that gives again more room to private companies to invest in this company. So again, a good thing from that perspective.
Good. And on the opportunity side, what about ESG? Is it a priority for the infrastructure industry? Do you have any concrete examples?
ESG, from our perspective, is a key priority, and it's also embedded in as a core investment principle in all our investments. If we look at our company, we started in 1994, and there we already had as a slogan EQT more than capital. Later on, we developed that. We subscribed to the United Nations principles. So there was this from the start. There was this ongoing commitment to responsible investments. Today, we took the next step. We set the purpose also in our articles of association, which is really the next step for us. And our purpose today is to future-proof companies and make a positive impact in everything we do. So we really want, also in terms of ESG, lead by example. And it's today part of our mindset, part of our strategy, and also a key differentiator. So very important to us. So maybe how does this translate in practice? So we have, just to mention maybe a few interesting examples, is we have developed at portfolio company level a sustainability framework to help portfolio companies to set ESG KPIs and also to report on these KPIs. So for example, on our website, you can see each investment ranked as to their ESG, as to where they stand in terms of ESG and the ESG goals. We have also, for example, appointed sustainable investors in the business line to lead all these ESG projects and have the focus on that. And we also committed to transition to 100% renewable energy for all portfolio companies. And another example, I think, is that we have also put in place an ESG linked bridge facility for our flagship funds in equity and infrastructure. So that's a bit what we have been doing and over the past year in terms of ESG. So maybe just to spend a second on how do we look at ESG going forward. I think we're not stopping here. It remains an important topic for us. And also with the coming out of the SFDR directive, where we have committed to comply with Article 8. We have started to implement that regulation, and we also committed to implement that in the most efficient way. Is it easy? I mean, it requires a lot of coordination and work across various teams, from fund management to capital raising and central functions, and will request a lot of additional reporting and disclosures. But we are today committed to execute on our mission on that. So maybe just to conclude on that, I think there is complexity around the implementation of ESG, but we believe that this is where we need to be. And we also, as a PE firm, need to take our responsibility in terms of ESG and make sure that the right things happen. And we also believe that providing financial returns should not be exclusive of being socially responsible, and that both can go hands in hands. So that's a bit how we look today at ESG.
In any case, we are infrastructure players. We invest over the long term, so 10 years, 20 years, for Ingrid is even longer than that. So the risk, the ESG risk, whether the environmental, social, or governance, they will materialize at some point in our horizon. And the same way, the opportunities will also materialize. So I think in the infra world, all players today have incorporated ESG throughout their investment cycle. Most of the peers I know of or I can think of, they do consider ESG in the due diligence in the investment committee. Then afterwards, they have action plan reporting. You can have different materiality, you can have different ways to implement those action plans, but we have now, as an asset class, at least in Europe, well integrated those subjects. It doesn't mean we cannot push further. It doesn't mean we cannot do better. And I think, you know, the taxonomy, the SFDR, mostly the taxonomy, can help us invest better, enter new sectors, etc. But that's in place. It might be incidental, but if you, for instance, look at the PRI ratings for the infra asset class, I think the median grade for infra players is A. And pretty much everyone I know is A+. So it shows the level of maturity that this asset class has, because simply we don't have really a choice. And then in terms of pragmatic example, it's important to note that it's not only about, you know, controlling your risks, it's also about creating opportunities. In IDEX, for instance, when we started, you know, it's a district heating business. When we started to try to replace the good old gas boiler by, I don't know, biomass, or use more geothermia, or introduce CSP, it also helps gaining new tenders. It also helps growing the company. And you can also have the social aspects. We have workforce that we need to maintain or that we need to grow. And the workforce in infrastructure is not that easy to find. For instance, fiber installers in Europe, they are difficult to find. Bus drivers in Europe, surprisingly, they are also difficult to find, especially in the Nordics. So you have to figure out programs to train and hire, and you can target, you know, youngsters, refugees, long-term unemployed, minorities. And that's a good thing for you because you source and retain talents. And it's also a good thing for your image with respect to the local authorities, which ultimately are your counterparts, your clients. So that's just example. I'm not saying we are doing, you know, the best we can and that we cannot improve, but I'll say that are reasons why our asset class tend to consider those factors. I will let Ingrid complement since she has even a longer view.
For us, sustainability is, well, it's in the name as well, so it has to be in substance too. And the long-term horizon does make it, if there was a need for that, but even more sort of relevant, because it doesn't become anyone else's problem in 10 years' time if we sell the asset. But to pick up on something that Aurelien mentioned, so the social aspect, I think what's interesting, especially after COVID, is that the S in ESG has taken a lot more of a front role after COVID, and that's, you know, that's always been a little bit the poor relative, you know, to comparing to the environmental side. So whilst it's got technical difficulties, you can measure a carbon footprint. It has been a little bit more difficult to articulate the social benefits and the economic development benefits that an asset can bring, and there has been a bit of a focus very much on the environmental side and ignoring, you know, the social side. And I think what we see now is that governments, investors, and sort of everyone is focusing on both, and that's a great that's a great development from this point of view. So I think we're moving from sort of compliance and getting the PRI ratings and all of these things to actual real integration. And having to really put your money where your mouth is, kind of thing. So, you know, because all of these sort of ESG requirements and reporting, they're only increasing, you know, as Nathalie mentioned, SFDR. It's a time-consuming, resource-consuming, and money-consuming sort of area to improve on. but ultimately it does mitigate risk, and it does bring opportunities and creates impact, and that's really important for the LPs, for the investors, who ultimately go back to their own stakeholders, which is ultimately us, sort of pensioners, insurance policy holders, and so on. So it's a bit of a circular economy in a different sense. And as practical examples, I mean, again, sort of focusing from to transportation in general, but with our ferry company, I think from a social perspective, during the crisis, the people who live on the Channel Islands would not have been able to function without it. So then if you start looking at what does that actually mean, you have, 160,000 people depending on the freight, the food and the medicine coming over. On the other hand, looking at the risks, the ESG risks that could come, and climate being one of them, again, we've commissioned last year a study to look at the potential impact of climate change on the weather patterns, and what does that mean for our sailings. I mean, the crossings that we have, they're not sort of island hopping like you have in the Nordics sometimes. It's a pleasant little journey of half an hour. The journey between the UK and the Channel Islands is a sort of anything 5 to 7 hours, not particularly pleasant at times due to the, it's a fairly bouncy crossing. And basically, if you have bad weather more often, or more sort of bad enough that you can't actually sail, that impacts your bottom line. So then you have to actually integrate some of those findings, or think about mitigants longer term. How are you going to sort of deal with that through your sailing program, through the kind of vessels that you put in place? So all of that sort of comes together a lot more cohesively in over the last few years, where the focus has increased on how do you actually integrate all these sort of quite theoretical concepts that started, came into existence maybe 10 years ago.
Great. So for the sake of time, now we will just accept the question that was put in our Q&A section, which then refers to the competition. How fierce is that competition against then the non-financial buyers and the strategic buyers in order to get those best targets and assets?
It's a difficult question. I mean, there's a lot of money, there's a lot of opportunities. So if you find your spot, you can get, you sort of find the right value in your investments. So everyone talks about competition and high prices, but ultimately, to some extent, those high prices, do reflect the liquidity that's available in the market, but it also reflects the overall drop in the underlying base rates. So, when you had interest rates at 5%, you had higher returns, and now they're zero. You would expect naturally the returns to be lower as well. We specifically, as I mentioned before, we target the sort of I think even comparing to Aurelien's mid-market, we're probably in the micro market, where you look at sort of 50 to 100 million investments. That's really a market where there aren't really very many players still focusing on that, because a lot of the funds have, if you look at concentration limits and effort, it takes the same amount of effort to do a 50 million deal as it does to do a 500 million deal. And if you've got the capital to do, if you've got 6 billion under management in a fund, which we've seen a lot of these mega funds appearing, you're not going to focus on that very small end. And that creates some value to be in that market. It's less competition as a result. So when we look at the assets we bought and what we see in our pipeline, we hardly ever come across the same competitors. Whereas if you put a big flagship asset on the market through a big investment bank, you will probably have the usual suspects plus a few others. And again, when you move into that sort of mega deal type, you have the direct investors coming through. So the insurance companies, sovereign wealth funds who invest directly. So again, sort of you have a lot of people chasing the big ticket deals. And then as you move down the size of the deal, you kind of find a little bit less competition and more opportunity for some bilateral discussions, less structured auction processes, and a bit more value. That's our experience.
I agree, and we're not too far in terms of where we're playing in the mid markets. So even in that field, I would say that you start seeing more competition depending on the sectors. If we take, for instance, the fiber sectors, today, even for really small assets, you start to see auctions. It's more difficult to make proprietary transactions. And then obviously you have some of the big strategic that come there. So the game is also to find new sectors, new geographies where there is a bit more space. And obviously, even though I would say this space of, let's say, tickets between 50, 100 something is less crowded, which is good because then you can sell to a market where bigger players are present. You also see those bigger players coming back to the mid-markets. If I take the example of Antin that had raised relatively large fund, I don't have that in mind, but I think they are launching now also a mid-market fund coming back to this segment. So you just need to keep adapting and finding other areas to grow. I would think that that's the key takeaway. And I don't think the strategic are more a danger than the, I would say, in terms of competition, than the other infrastructure players. On transaction today, it's not necessarily the strategic players that win. Sometimes it's the infrastructure fund.
We actually like to partner with the strategics because we are a financial investor primarily, and in the assets we bought so far, and if I look at the pipeline, we've always got a strategic in the shareholding, and that gives us that. We think it's a very good competitive angle as well, because whilst they're not more aggressive purely on pricing, they bring sort of operational benefits and synergies that you wouldn't otherwise get. So for us, we see strategics potentially as partners, especially in the sector that's in the area that we operate in.
Yeah, maybe to add on that, I think what we see is obviously the competition is high, but what we also currently see, because the competition is high, is what becomes more important is the long-term relationship. So we see also that we have been following different portfolio companies or different targets for some years before it actually materialized, and that's how we build the relationship with the management on the other side, and at the end, because they know that we are a good company, they are convinced to sell to us rather than to others. So that's I think that becomes even more important given the competition out there.
You have a lot of companies still in the infra space where you have like family-owned businesses where I'm thinking public transport notably or some of the transactions in public transport that we made recently. They're all family-owned business where the owner or the creator of the business is going to the age of retirement. They know us, so that develops the relationship, and that do help. Obviously, there is always the risk that it ends up in an auction. It occurs that you develop those situations over the year, and unfortunately, it doesn't translate in a proprietary transaction, but in an auction. But that's also the work we have to put.
I'd add just one more thing, and that's really from the perspective of an open-ended fund. If you look at the existing ones that have been around for a number of years, you will see that probably 40 to 50% of their invested capital has probably been in existing portfolio companies. So when with an open-ended fund, you never stop investing. So your investment period doesn't stop at like 2, 3, 4 years. So there is always an opportunity to grow the businesses that you bought in the first place. And that's a huge source of opportunities, because then you end up, to some extent, closed-ended funds do that too in their investment period, or they sort of reserve some capital for some, what you can predict over the next few years. But with an open-ended fund, if you take a sort of long-term view of sort of 10, 15 years, you can continually put equity into those businesses and keep growing it. And it's a new investment case each time and so on, but it does provide a semi-proprietary source of opportunities that you don't have to necessarily compete with the whole world.
And that's also something that I think a lot of infrastructure players tend to do today is they are less afraid of greenfield. even if you start with a brownfield base, doing greenfield, developing your assets, whether it's by gaining new tenders, new concession, or private deployments, whatever, the myth of the huge construction risk, etc., that was maybe there 10 years, 20 years ago is less prevalent today. We're more prone to taking that risk. It's also more accepted by our LPs that we make this. Because typically, if you develop a good company and you have a good base, you're competing for projects with much less people. When you bid on a concession, you're bidding against 2, 3, 4, 5 people maximum, not against 10, 30, as we can see in some auctions for the purchase of the asset itself. That's also a way to a bit dodge the competition, is to identify and find the right platforms and grow them.
Great. That was really a very interesting and robust webinar on infrastructure. Thanks, dear panelists, Nathalie, Ingrid, Aurelien, and also Alexis for joining us today, for sharing many, many details concerning the infra class, asset class, to also open the discussion, open-ended, evergreen, closed-ended, also very interesting. And also just wanted to say hi to Andreas, who then was able to create the bridge between the PropTech and infrastructure world in the chat. And certainly also thanks a lot to you, dear audience, for joining us today. And just wanted to highlight also the next events the LPA has planned. We have 3 already in April, one with BlackRock concerning the careers and talents, another one with Alpha Private Equity for the PEVC stories in Luxembourg, one with Invest Europe and the Luxembourg ambassadors here in order to discuss the European public affairs, and also one in May with the Big 4 PE leaders in Luxembourg. Thanks a lot for joining, and hopefully see you very soon. Bye-bye.